Well, the biggest change has been in communication. When I started in tax in 1981, we communicated with clients by letters, which were delivered by the post office. International communication was by telex, those long tapes which were fed into the machine. Then during the 1980s, we transitioned to fax, and then in the 1990s to email. That communication revolution has meant that the speed at which international tax advice is given has increased enormously. In the early 1980s, there was generally a leisurely pace of a week or perhaps two between the request for advice and the giving of the advice. Compare that with now. Frequently, we now have an expectation that same-day response or maybe next-day response will be given. The identity of clients is a major change. Before 2002, in other words, before Enron, before the Anderson collapse, before Sarbanes-Oxley, almost all of the tax clients of a major accounting firm were also audit clients of the firm. Now, particularly when you're talking about publicly listed companies, the opposite is true. Another major change is the high level of discipline which the big accounting firms now apply to tax engagements. We have the two major requirements: internal conflict check and a comprehensive engagement letter, which generally limits the firm's liability to a multiple of the engagement fee. The Big Four will not provide tax advice today without completing both of those requirements. And yet, when I started in tax in 1981, both of those requirements were unheard of. Then there's community attitudes to tax planning. That has changed over the years, but probably the major sea change was the naming and shaming of multinationals after the global financial crisis in 2008. Ever since then, tax reputation for multinationals has been a board-level issue. That was not the case in the past. And finally, there's specialization, particularly in the big accounting firms. The number of areas of tax which have become the domain of specialists has grown enormously over the years and continues to grow. Specialization in tax topics, such as tax accounting methods or tax depreciation or R&D incentives, and specialization in industries, financial services, real estate, resources, manufacturing, consumer products, on and on. That's both advantageous and risky. The advantage is that the specialist should have deep knowledge on their particular topic. The risk is that the specialist might have very little knowledge of anything else. Silos are very dangerous and very annoying for clients. Imagine that you're a client and you have a meeting with your tax advisor at a Big Four firm and 6 people turn up, your relationship partner and 5 specialists. You'll be trying to work out how much this meeting is going to cost you.